we're arguing is you should do it on a logarithmic scale. And if you take that range that was like $4 to 50 for 50 years and you double it, you double the range on the log scale, which is like a tenfold range, $4 to 50. You're talking $500. Don't chuckle. The interesting thing, well, where will we be, let's say, about 3 months into this move? Will we be under 100 or will we be well over 100? And then we get a jiggle.
Viewing silver on a logarithmic scale changes the entire perspective of its long-term price behavior. A move from $4 to $50 over nearly 50 years already represents a tenfold expansion, not a minor fluctuation. Michaeloliver explains that when such a range is doubled on a log scale, it doesn't suggest incremental upside. It mathematically opens the door to prices near $500. This framework is critical because exponential markets do not advance linearly. Early phases may hover below $100, creating doubt, but once momentum fully engages, prices often surge far faster than expected. The key question isn't whether silver pauses or jiggles, but how quickly it transitions from consolidation to acceleration. Logarithmic analysis reveals that what looks extreme on a linear chart is often normal during secular breakouts. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I knew we'd get the 60, I thought we'd get the 60, 70 by the end of the year, but ultimately it is not a target. I think we've begun a phase in silver that we've explained to our subscribers over the last handful of months is likely to be a jolting one that takes silver to what we call a new reality. Meaning not just doubling the price, but, more likely quadrupling or more the price very quickly, meaning within 2 quarters, thereabouts. The signal that generated that was not the fact that the net trend of silver and gold is positive. They've been positive for a couple of years. They zigzag, but, it's been net trend positive. So it's not that issue. It's the issue of the relative performance relative to, one, the stock market, meaning a breakout that is clear, technically speaking, in which the performance of gold, for example, versus the S&P is no longer a dual, which for the last 10 to 11 years, if you looked at a spread chart of gold divided into the price of the S&P, you'd see this basing pattern with ups and downs within it, in which case gold outperformed for a year or two and then pulled back some, and, so basically sideways, where it was basing relative to its performance to S&P. It broke out of that pattern in November, and now it's 1 month later, and we've gained hundreds of dollars, and the spread has continued to explode. But also, when we analyze gold miners, gold and silver miners, like let's say GDX or XAU, and divide it into the S&P 500 and plot the same chart going back a dozen years, lo and behold, it broke out also in November, meaning, which place should I be, the U.S. stock market or gold and silver miners? Well, it said gold and silver miners. Well, they've roared since November. They've been roaring before that, but this thing said something just began. This is a big metric. I mean, you don't build a base that's 11 years wide, clearly defined with multiple highs that hit the same sort of level, and you can draw a line, anybody could, and you break through that. That's a breakout. It's fresh. And silver did the same. But the other thing that we thought was more important for silver is that it broke out versus gold, meaning that if you want to allocate assets to monetary metals, fine, that's what these charts tell you to do. But within that complex, you want to preference silver. It's likely to lead. Silver's also broken out of its what we call the idiot range, which it's been in for 50 years. $50 for $4, $50 back down, 50 years in a range, an old normality. We showed in reports a couple months ago a similar situation in copper and lead that had prevailed back in the 70s through 2005 to 2007. It's like multiple decades of range-bound action by both those base metals. And in 2005, copper broke out of that range, and in 2 quarters, it quadrupled in price. And then lived in a new reality subsequently. Now it's breaking out again to another reality. Lead did the same thing. In other words, when it finally decided in 2007 on its own merits to break out of a multi-decade old reality, it quadrupled in a matter of a couple quarters. What's going on here? Well, it's when a market discovers, oops, I made a mistake. I shouldn't have been here that long. Boom. Markets make mistakes. They're not rational all the time. And anyway, silver is now, by our metrics, the spread chart versus gold, especially saying, okay, I'm out of here. We think silver is highly likely to go, I think personally, my own positions, which I expose in the report at the end in a disclaimer, is likely to see, $200. And it might even see it within the next handful of months. In other words, within a couple quarters of that breakout. So put your seatbelt on and don't expect normality. If you go back and examine the two acceleration phases of silver that occurred within the old reality, that would have been 1979 to 80, when after years of advancing already at that point, silver exploded. It like quadrupled in a matter of 5 months it was. Went from like $12 to 50, okay? And then in 2010 and 11, again, after years of advance, so it wasn't like some new game, silver doubled in a half in about 7 months. Boom. But in the middle of both those moves, if you micro-analyze them, which we've done, there was in fact a midpoint, what you might call stumble or a midpoint pause or a midpoint correction. It really didn't amount to much other than for a moment in time, making people feel like, oh my gosh, that's the top. But that was only like 3 months into what we define as the couple quarter move. And so sure enough, after that little jig-jag was over, right about in the middle of that clock, they exploded again, even more so than what they'd done in the first half of that clock. So the question now is, let's say we got a signal in the close of November. So let's say this is month 1, 2, 3. So maybe you get to February or so. At that point, we're going to be focused at MSA on trying to define any midpoint stumble. It will be a fake out, but we still know that there's a lot of, including myself, a lot of investors who are positioned in call options and therefore are sensitive to such fluctuations. So it would be an important thing to avoid if you can, but you don't, as an investor, want to get out of silver at that point. In fact, you don't want to get out of silver, period, even after the 6-month move, because there's a new reality about the dawn. And while price will have made much of its move, the interesting point, though, will be, let's assume the 6-month clock is about right, give or take a month, okay? And again, this happened to copper, it happened to lead, it happened to silver twice in the past 50 years. Where are you going to be at the midpoint of that move? Could be very interesting. Are you going to be 80, 95, let's say $95 to $100? And I picked that because that's a stupid level. Why is that stupid? Because if you take the arithmetic range of the past 50 years and you simply add it to itself, the target would be roughly somewhere close to 100, $50 range added. So it's sort of an idiot technical analysis. What we're arguing is you should do it on a logarithmic scale. And if you take that range that was like $4 to 50 for 50 years and you double it, that means you double the range on the log scale, which is like a tenfold range, $4 to 50. You're talking $500. Don't chuckle. The interesting thing, well, where will we be, let's say, about 3 months into this move? Will we be under 100 or will we be well over 100? And then we get a jiggle. Because that sort of sets your dynamics. You think, well, if we got this far in the first 3, good grief, where are we going to be in the next 3? Maybe 200's too low. So we're not certain on where that peak might be in 6 months or so. Although I would argue at least 200. But a lot's going to be told in the next couple months. Where do we go, let's say, within 3 months of that signal?
Silver's advance towards $60 to $70 was expected, but that move merely confirmed a structural shift already underway. The real development is the violent repricing phase now unfolding, where silver exits decades of suppressed valuation and enters a new regime. Breakouts against the S&P 500, alongside simultaneous strength in gold, silver, and mining equities, signal a decisive rotation away from U.S. equities. More importantly, silver has broken out versus gold and escaped a 50-year containment zone between $4 and $50. Historical analogs show that when markets abandon multi-decade ranges, they rapidly correct past mispricing, often quadrupling within months. Linear targets near $100 fail to capture this transition. Log-scale behavior points to acceleration toward $200 and potentially far beyond as the new reality asserts itself. Let's get back to the interview.
Gold is now always been the mama market of the monetary metals. Okay. People forgot that silver is also a monetary metal and has been for thousands of years and is likely to become so again. Okay. The poor man's gold. But gold, if you just simply go back, and I've said this over and over in interviews, that if you go back and look at the last 50 years of gold and put it on a ratio scale chart, like I mentioned about silver, $4 to 50, back and forth. If you take that same log scale, it says you're going to 500, to match the dimension. In the case of gold, though, it's had a high at $850 in 1980 from a low around 100 in 1976. So 3.5-year bull trend, 8-fold gain times the bare low. Okay. Then in 2001, you made lows at $260-something gold, and you went to 1920. Oh, it took you 10 years to do it. 8-fold move. So ratio scale, the same dimension, though much higher each time, okay, on the log scale chart. Now gold is beyond the 2000 high in 1920, and if you measure from the bare low that preceded where we are now, that was 2015, gold made a bare low at 1,050. 8-fold says mid 8,000s. Okay, right now we're 4,500. We're only 4-fold into the same type of move we had twice before in 50 years under conditions that are nowhere near as dynamic fundamentally or technically as existed then. We're much stronger. We have much more potential. So when I say 8,000 gold, that's not a prediction. That's saying, hey, if we simply do the norm one more time, we'll be 8,000. Well, can you imagine where silver might be given the fact that it's breaking out versus gold or spread relationship? And I'm arguing that if you go back over the last 50 years and look not at the range of silver, but where were its spread readings versus gold? What was its relative value? In 1980, it was 6.5% of the price of gold. In 2011, in that bull run, it was over 3% of the price of gold. Right now, we're just above 1.5% of the price of gold. Imagine if the relative performance, which again is technically broken out, matches or exceeds the relative performance level it saw in the last 50 years, like price has already done. What if the spread does the same thing? Silver goes to beyond 3% of gold, or maybe beyond 6.5% of gold, particularly in the next 6 months. That means if gold's 8,000, you do the math. Your jaw will drop. So I think you have to open your mind to that possibility too. So gold getting to 8,000, even if it just goes there, the norm, the question is where's silver going to be? Wow. The stock market decline is not going to commence right now because we've already wasted too many months on monthly momentum of the S&P or NASDAQ and trying to go down on those metrics. You get downward readings on momentum, yet price was just struggling sort of sideways for especially the last 3 months. So when we see that waste of time on momentum, where there is a decline on the momentum readings, but no real response by price, then as far as we're concerned, for the moment, the bear clock is over. They've had their chance. We're likely now to see, and we said this in a report 2 weekends ago, you're likely to see further gains in the S&P before you even start to top again. But overall, from an investment context, we've been arguing that since early this year, when the S&P was like just below 6,200 at the peak then, that what you're going to see is a topping process. Could involve a year. That's what happened in 2000. That's what happened in 2007. It took a whole year of this twisty-turny but slightly rising action to top it out. But the structures that we see on momentum that could cause a precipitous drop are next year likely to be in the mid 5,000 area. So in other words, 1,000 points below, like a 20% below where the market is right now, before you hit levels that will cause a sharp drop. So in other words, we could see the stock market roll over, gold continue on up, silver, etc., and not see the stock market really get kicked in the shin until you get down into that 5,400 zone. There's technical reasons for that. When you hit that level, you could see a sharp drop. But who knows? Maybe at that point, you're in April or May, and suddenly your 6 months on silver are over, and silver's reached some kind of level like 200 or 500 or whatever, and has a sharp correction coincident with a stock market break, but at a new reality level. The issue is getting to the new reality for silver. And right now, I don't think the stock market is going to be a problem in terms of generating anything drastic on the downside.
Gold has always led the monetary metals, but silver's role as money is reasserting itself after decades of neglect. On a logarithmic scale, gold's last two major bull markets each produced eightfold gains from their bear market lows, first from $100 to $850, then from roughly $260 to $1,920. Applying that same historical dimension to the 2015 low near $1,050 points toward gold in the mid-$8,000 range, a level consistent with past cycles rather than an extreme forecast. Silver's setup is even more asymmetric. At just over 1.5% of gold's price today, it remains far below prior relative peaks above 3% and even 6.5%. As equity markets extend their topping process and metals continue to diverge, silver's re-rating toward a new reality becomes increasingly plausible. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.